This is a discussion of the Hubris Hypothesis. I'm your professor, Dr. Stephen Haggard. This discussion focuses on a paper called The Hubris Hypothesis of Corporate Takeovers. It was written by Richard Roll and published in 1986 in the Journal of Business. So what is the central prediction of the Hubris Hypothesis? It's that the total combined takeover gain to target and bidding firm shareholders is non-positive. What does that mean? Well, if we take the number of dollars of increase in the target shares price multiplied by the number of shares and add it to the change in the bidding firm's share price multiplied by number of shares, that total is either zero or negative. That's what non-positive means. If you read this entire paper and didn't know what hubris was and didn't bother to look it up, shame on you. So what is hubris for those of you who didn't? It's excessive pride or self-confidence, arrogance. Now, when we say excessive pride, that's pride over and above that which is deserved through one's own worth. In other words, they think too much of themselves. So who does Roll think is afflicted with hubris in corporate takeovers? It's the bidding managers. These managers look at the target and they assume that they can run the target company better than the current target company management. Furthermore, they think they're smarter than all market participants because they know the true value of the target and the other market participants apparently do not. Roll says that bidder managers might over or underestimate the value of a potential target, but do we observe all of their estimates? Why or why not? Well, we don't, because when managers underestimate the value of the target, they don't make a bid. Think of it this way. The target company is currently trading at $20 a share. We do a little analysis as bidding managers and find out that the company's worth $18 a share. Do we make a bid of $18 a share? Of course not. No one would sell to us. The stock's currently trading at $20. We would only make an offer if our estimate came out higher than the current stock price. What prediction does the Hubris Hypothesis make regarding the share price of the target upon announcement of an unanticipated bid? At the failure of a takeover bid if no other bids are received? And is there evidence consistent with these predictions? Well, first of all, the target share price should go up after an unanticipated bid. Now, it has to be unanticipated because otherwise the share price would creep up beforehand. And so if this bid is a surprise, the share price should go up. Now, it won't go up immediately to the offer price because there's not a 100% probability that the deal will go through. But as we see the probability of deal closure getting higher and higher, we'll see that target share price get closer and closer to the bid. Now, what about if the bid fails and there aren't any other bids received? Well, Roll predicts that the share price would go back down to the original level. And do we see evidence consistent with that? Yes, we do. If the target price does return to the original level upon bid failure, what does that mean about the amount of new information about the target that is contained in the bid? Well, it tells us that the bidder's offer did not contain any new information. In other words, the bidder did not have any sort of secret inside non-public information that was conveyed through their bid. So why might a bidder's share price drop upon announcement of a bid? Well, if market participants think that the bid is a negative NPV project for the bidder, then the bidder price should go down. When would the offer have a negative NPV? Well, if the bidder offers more for the target than the target's standalone value plus the incremental value created by the merger. This could happen if the bidder overestimates the incremental value created by the merger. Why might they overestimate the incremental value? Hubris. They think they can do great things with the target firm that the current target management can't do. So why might the bidder's share price rise upon announcement of a bid, even if the acquisition itself destroys value? In other words, that the bidder is paying too much for the target. Well, it turns out the bid might also contain new information about the bidding manager's assessment of their future earnings. Think about this. If you get a big pay raise at work, you might go out and buy a new Porsche Boxster. Now your neighbors don't know about your pay raise until you show up with the new Porsche Boxster. Now they have new information about your future earnings that they didn't have before. And it's similar with bidding managers at firms. If they think their cash flows are going to be better going forward, they might be more willing to acquire another firm and definitely more willing to pay cash. So what does it mean if the bidder's share price gets lower as a takeover starts to look more likely? That means that the market thinks the deal destroys bidder value. As the probability of deal closure increases, the expected amount of the loss, which is simply the probability of the deal going through multiplied by the value to be lost if it does go through, gets greater. Similarly, we will see the target firm's stock value rise toward the offer price as the deal looks more and more likely to close. Why might a cash offer for a target generate a higher bidder announcement return than a stock offering? Well, when is a bidder willing to offer their stock instead of cash? It's when they think their stock is overvalued. If the bidding managers thought their stock was undervalued, they'd certainly be willing to use cash instead of their precious undervalued stock. But if they think their stock is overvalued, they'll be happy to use this inflated currency to go out and make purchases. A good example of this? America Online bought Time Warner with stock. And as we saw in the late 90s and early 2000s, AOL stock value plummeted. Finally, why might bond prices of bidders in cash deals drop upon announcement of a cash offer? Well, paying cash reduces the probability that the bidder will be able to repay their debt obligations, raising the risk of such obligations. Think about a person that has a $300,000 mortgage and $100,000 in the bank. If they lost their job today, they would be able to make their mortgage payments for several months before they got into trouble, probably long enough to find another job. However, what if they went out and spent $97,000 buying a new German sports car? Now they only have $3,000 in the bank. How long can they last if they lose their job? The answer is not very long at all. And so by spending that cash, it's no longer there to make debt payments, and therefore the probability of bankruptcy goes up. When the probability of bankruptcy goes up, the market's going to require additional return. And we know that additional return on bonds means additional yield to maturity, which means lower bond prices.